One question we often get is, how do we avoid capital gains tax? Capital gains tax occurs typically when you buy an investment, whether it be a house, rental property, investment portfolio, stock. When you buy it and you hold it for more than a year. Anything less than a year, you pay regular income tax on. But capital gains tax gets applied based on your income. So there's different levels of income. It could be 0% capital gains tax, which is a little harder to do because you basically have to have no income. It could be 15% capital gains tax, or around 400,000 or more in income, you start paying 20% capital gains tax. This tax is applied on the gains on the investment. So if you bought a stock for $100,000 and it grew to $200,000 and you sold it, you'd pay income tax on the $100,000. So there's a couple of ways that you can avoid capital gains tax. One, obviously a little harder, but if you're in a time period of your life where you don't have any earned income or any taxable income, there is a threshold. It's a little different for single versus married filers, but there is a threshold where you can pay zero or low capital gains tax. The other one is actually coming up with a capital gains harvesting in your side of your portfolio. So good money managers should be doing this with your investments. Meaning in 2020, when we had the big drop in the market, in 2022 with all the stock market volatility, there were opportunities to sell things for a loss while still being invested. So when the market rebounded, you still participated in that. A good example would be like selling SPY, the S&P 500 ETF, and buying VOO, the Vanguard S&P 500 ETF. You still invested really in the same securities, the underlying securities, but the IRS allows you to sell one for a loss, buy the other one. And so doing this tax loss harvesting inside your portfolio, you can create negative or tax credit. So for example, we had a portfolio last year that we were able to harvest about $300,000 in capital losses. The portfolio was still invested in the market. It rebounded along with everything else. But now we have this $300,000 credit that's sitting there. So for future capital gains that are taken or need to be taken, we can now offset those losses with gains, so there's no tax. So a good tax loss harvesting strategy is important. Also, some people will ask this, so we'll go ahead and answer it now. Inside IRAs, inside retirement accounts, you don't pay capital gains tax. You pay income tax when you withdraw the money. So this strategy would not apply to those accounts, just brokerage accounts. Hope this helps. Reach out if you have any questions.